Hello and welcome to the SS&C Intralinks fireside chat series. Inside the LP mindset, strategies for building resilient GP-LP relationships. I'm Andrew Welch, Vice President for Alternative Investments for the Americas at SS&C Intralinks. And today I'm joined by Neal Prunier, Managing Director, Industry Affairs at the Institutional Limited Partners Association. Today, we will be covering a host of topics: strategies on building strong investor relationships, alpha perspectives, fundraising trends, technology's role in monitoring portfolios, and recent ILPA initiatives and regulatory developments shaping the private equity landscape. So, Neal, I will pass to you to introduce your good self.
Hi, Andrew. Thanks so much for the introduction. And as always, thrilled to have the opportunity to talk with you and the community with SS&C and Intralinks. Always a great opportunity. As Andrew mentioned, my name is Neal Prunier, Managing Director of Industry Affairs at ILPA. And the way I typically like to explain my role is I sit across both our bottoms-up efforts with our standards and best practices, as well as our top-down efforts with our legal and regulatory affairs efforts. And so it's a great opportunity to talk about the topics at hand because they do really blend our work across standards and best practices, as well as legal and regulatory affairs.
You sound like a busy man. So, as we sit here feeling the warmth of our virtual fireplace, let's tackle the first topic: fundraising, everyone's favorite part of the process. So, how is the slowdown in exits influencing LP allocations across different asset classes? And is liquidity as much of an issue as it has been in the past?
Sure. And a couple words that I want to zero in on there as think about the response to this. The first is asset classes. So one thing to keep in mind right now in the current environment is that the sentiment when you think about private equity is different than the sentiment when you think about private credit. Private credit is performing at all-time highs and has a lot of deal flow taking place, whereas on the private equity side, have seen a significant slowdown in the rate of exits and in true distributions. And when I say true distributions, I mean companies selling or GP selling companies and receiving proceeds as a result, a real distribution, not a continuation fund, not a NAV-based facility to facilitate distributions. So this is then having an impact because of the return expectations, but then also fundamentally the money coming back to LPs via distributions is what feeds the next re-up, whether it be in the same manager and their next fund or whether it be in a different manager. So there is a direct connection between the slowdown in exits and then the LP's ability to make their next round of investments. So what we're seeing is LPs have to be that much more mindful about the size of the checks that they're writing, as well as taking into considerations potentially shrinking this number of commitments they're making and the number of GP relationships they have on an ongoing basis.
Interesting. Okay. And are you seeing a preference for specific investment structures, things like co-investments, secondaries?
Sure. So for the LPs that are able to facilitate it, I think co-investments are always going to be one of the top priorities. And that's one of the reasons LPs are making certain commitments is to be able to get co-investment opportunities. On the topic of secondaries, we have seen this become much more part of the normal conversation for LPs relative to years ago when an LP had maybe considered doing a secondary once, but perhaps had not yet done one. Now LPs are starting to think about how do we run secondaries as part of our annual positioning and annual trimming of the portfolio. And that's just a complete difference in how it had been a few years back.
Interesting. Okay. Well, as you know, SS&C Intralinks, we run an annual LP survey. We have a focus group of LPs and we run the survey on an annual basis. And what we found is that co-investments came out on top 37%, followed by secondaries 24%, and then a continuation funds at 11%. And then from an industry perspective, tech and healthcare were the top two sectors LPs are looking to invest in. So that was pretty interesting. Can you share some updates on your standardized DTQ? Do you see adoption? What do you see in terms of adoption by the industry?
Yes, we continue to see strong adoption on our standardized DDQ, which was last updated and released in 2021. And despite it being released about 4 years ago, on an annual basis, it remains one of the most downloaded resources on the ILPA website from across the industry. When I think about adoption of the ILPA DDQ, I typically like to think of it as serving 80% of an LP's questions, recognizing that 20% is always going to be unique data needs for an LP based off of what's important to them as an organization, their CIO, their particular jurisdiction and different legal requirements. So that 20% of customization makes sense given the nature of the DDQ. But we do continue to see DDQ adoption be strong across the industry because of how important it is for LPs during their diligence stage of the process to get that level of information, but then also for GPs and the other providers, the benefits of having something standardized so that you can have a more consistent set of responses available and able to provide rather than needing to respond to ad hoc after ad hoc after ad hoc DDQ.
Got it. Interesting. Okay. So that is quite insightful there from a fundraising perspective. Let's move towards technology. So one of my favorite subjects. I've been working in this industry for 20 plus years now, showing my age, but just a quick note to the audience. There is a Q&A section. So I do encourage you to post questions to there. We'll obviously have a conversation, Neal and I, in this fireside chat. But I will endeavor to tackle your questions towards the end of the conversation. So please do post your questions there. So technology, it's obviously plays a huge part in our day-to-day lives and particularly within the industry that we work with it. So Neal, how has LPs' demand for data shifted in recent years? What sort of data are LPs asking for from their GPs?
Sure. That's a great question. I think in all facets of life, we've seen technology improve and the capabilities of technology be significantly enhanced in the last several years. And that's something that LPs are experiencing as well, especially as LPs have made the shift. And this goes back more so 5-10 years, but making the shift to be much more comfortable with buying technology solutions than building internally. That has really allowed for groups like SS&C, as well as others in the industry, to produce technology for LPs that just has much greater capabilities. So when we think about the data for LPs, even if we go to something like the DDQ, it's being able to take the DDQ out of a Word document and put that information into systems. So being able to have a lot more comparability across your entire portfolio is extremely important for LPs. One of the trends that we've also identified in some surveys we've done of our members is an increased emphasis on data related to fees and expenses, especially as more and more fees have been passed on to the partnership itself and not fully covered by the management fee, as well as data related to the impact of sublines, being able to better understand with and without performance, being able to get greater insight into future capital calls, given the existence of a subline. One of the areas that ILPA focuses on as an organization is across the tenets of alignment of interest, governance, and transparency. And so when you think about the demand for data, there's been a real big increase in the number of tools used by GPs. So not technology tools, but things like sublines, continuation funds, NAV-based facilities. And so another area for LPs is just to make sure that they have the data to feel comfortable with these new tools that are getting used by GPs across the portfolio.
Interesting. And a question that we're constantly seeing from SS&C insurance perspective, customers who ask themselves, do we buy or do we build? Do you have insight into the LP community in terms of which direction they go? And obviously there's different factors in there, the size of the LP, right? But do you have a kind of insight into whether people are buying or looking to build internal solutions?
Yeah, and following on what I highlighted before, we've identified in surveys of our members a increasingly strong preference for buying technology rather than building it internally because of the solutions that are now being offered. You know, if you think about the late 90s, early 2000s, it made sense why a lot of LPs were building this technology internally, given their ad hoc needs and given where the industry was in general. But we've seen an influx in the number of technology providers in this space, which means that the bar for the standard technology being provided has also increased significantly while the costs have come down. So LPs across the board have been shifting to more of a buy focus than a building internally.
Yeah, I'm glad to hear that. That's exactly what we're seeing, right? Customers are looking to buy, to focus on higher value tasks, and that from a technology perspective, but also from an outsourced managed service perspective, whether, you know, taking over postings or document aggregation, these other type of managed services. People are really looking to streamline their operation and focus on the revenue generating side of things. So that's interesting.
And this is, and this is something that, you know, going back to the DDQ, we've added questions related to GPs and their use of third-party fund administrators versus doing the work internally. And one of the reasons we've added that question is because, again, technology has become so much more common. And the thought being, if this GP can't be best in class in doing it internally, why are they not doing it externally? And I think the same applies to LPs as they think about their operations.
Mhm.
Can they be best in class internally in building these tools? Or if not, they should be working with an external third-party provider. And I would go out on a limb and say, you know, SS&C has many more technology employees than most LPs do. And so it makes sense to be working with third-party providers because of the specialization and development work that is taking place across all these various platforms.
Yeah. And obviously, software as a service as of today, there's continuously incremental innovations and updates coming, and that's going to be cost to bear on the customer's side. So better to outsource that. So we've talked about the why. Let's talk a little bit about the how. So how are LPs leveraging technology to enhance transparency and improve portfolio monitoring?
Sure. So getting information is a key first step. Within getting information, and we'll talk about this a little bit later on, but being able to have the data in a standardized format is so important for LPs. You're capturing information across your entire portfolio. So the less amount of manipulating of the data you need to do to be able to make it apples to apples comparison, the better it is. So as LPs are able to get information in-house in standardized format, it then allows them to look across their entire portfolio to understand key portfolio data points. You're thinking about fees and expenses and performance, as I mentioned, but also sector exposure, vintage year exposure, geography exposure, so that they can understand how the full interplay across their investments. And a lot of LPs are doing this across not just their private markets portfolio, but then also seeking to do this across their entire investment portfolio to understand across their alternatives as well as their traditional long only and fixed income, what is their total exposure to a particular sector or to a particular country. So getting this data in a standardized format is what's so important for LPs to be able to look at this information and make better decisions as it comes to re-ups, as well as then increasingly one of the other items you identified before, continuation funds, so that they can do the analysis on that particular company and understand what that does across their entire portfolio.
Yeah, absolutely. Going back to the LP survey that we did, the focus group, 95% of investors surveyed said that an aggregation tool for data across their portfolios would be helpful. And using technology can help them gather that information and make better decisions. And so, quick shameless plug here, but we are very excited to take to market a new solution called InView. And this is a solution to help investors minimize the time it takes for them to aggregate information across all of their fund managers. This is obviously a task that's both time consuming and error prone. So if you'd like to hear more about that, please reach out to myself or your local Intralinks representative. Shameless plug over. So Neal, what emerging data or analytic trends are helping LPs make more informed investment decisions?
Sure. And so, I've referenced some of the different data points, but just to break it down as we think about it, there's the fee and expense information that's typically at the fund level. There's the portfolio information, which is typically at the fund and LP specific level. But then where we've seen a lot of adjustments and developments is thinking about the portfolio company, portfolio investment specific data, because that's what really unlocks some of that more advanced analysis, looking at some of those sector and geo exposures, looking at different risk analysis, and looking at the drivers of performance at the fund level. So the more that this information can be granular, looking at portfolio companies when necessary and when possible, the better. Ultimately, what LPs want is data at their fingertips so that they can better manage their portfolio across the board. Due to the nature of private equity, the more LPs, for example, can get information about the timing of upcoming capital calls because of the use of sublines, the better that allows LPs to manage their equity portfolio because they don't necessarily have to sell unexpectedly to be able to meet the needs of an upcoming capital call. So LPs are looking across the board of how to better understand their portfolio going into the weeds, as well as starting to look out more from a cash management, total portfolio management standpoint.
Very interesting. So you've got a really interesting perspective and fantastic view with ILPA. Let's talk about some of the initiatives and industry standards. So can you share some insights on recent ILPA initiatives, including newly released reporting templates? How did you, or how much did the now vacated SEC private fund advisory rule influence your updates to the templates? Let's talk a little bit about that.
Sure. So as a reference point, earlier this year in January, and we had some great representation from SS&C on our working group, we released an updated version of the ILPA reporting template that captures fee and expense information on a quarterly basis, as well as a new template, the ILPA performance template, to capture, in essence, inception to date on a quarterly basis, performance across the fund, looking at a set of standard performance metrics, and in some ways, most importantly, the with and without performance, all being done in a standardized calculation approach. So we released these new templates in January, and they're going to be implemented for the first time for the reporting template. The first time it'll get delivered is 1Q 2026. So after the 1Q reporting period, and the performance template will be after the 1Q 2027 reporting period. So these are key new templates to further push for transparency in the industry, giving LPs better access to the fee and expense information, especially as I mentioned before, because so much more is getting passed on to the partnership than it did in the past, as well as being able to get better insight into performance, especially the with and without, because of how omnipresent sublines are today. We released these templates this past January, so a couple months ago. This was based off of work that picked up in earnest at the beginning of 2024. And when we picked up the work in the beginning of 2024, we had one working group for each template. These working groups consisted of roughly 15 organizations each, and we really tried to have a diverse array of participants. So we had, roughly speaking, a third LPs, a third GPs, and a third service providers. We also had a steerco and satellite groups that we worked with more closely. But when this picked up at the beginning of 2024, it was built around implementing for the benefit of the industry the quarterly statements rule within the private fund advisors rule from the SEC. We were very transparent, however, with all these various groups from day one that we planned on pushing forward the work, whether the rule was vacated or not. We felt that this new reporting represented the next natural evolution of the ILPA reporting standards, and it was the right time to be pushing this forward, and it was a major area of emphasis for LPs. So initially, the templates that we were putting together did mirror the requirements outlined within that quarterly statements rule. However, the rule itself was vacated in early June. And so at that point, what we did was we took a temporary pause and we examined the templates that we had been putting together to identify where were we adding specific sections or structure or line items for the purpose of meeting the quarterly statements rule language versus where was there deep interest amongst LPs and GPs for an industry solution on those same data points. So we were able to make adjustments to the documents to create something that we think had a stronger orientation around an industry-driven solution rather than fully meeting the requirements of the SEC rule. We then ran a comment period and got over 100 different submissions across the industry on our templates to eventually come to the final design that we released earlier this year. So it's been a long process. That was a bit of a long-winded answer to replicate the long process that it's been working on these templates, but we're really thrilled to be where we are today with the templates out, starting to talk even more closely with groups about implementation to drive adoption across the industry.
Yeah, no, it's not long-winded at all. It's a very interesting, deep topic. I mean, ILPA has been a driving force in creating standardization in the industry. What other steps do you think need to be taken to improve standardization and transparency in private equity reporting?
Yeah. So, realistically speaking, because of the rule being vacated, and because of the decision from the Fifth Circuit Court of Appeals, we recognize that there's going to need to be a much greater emphasis on efforts from the industry to push forward new standards. So I referenced that part of my job is legal and regulatory affairs, and part of my job is standards and best practices. Our view is that we need to be actively working as an industry to double down on the standards and best practices space, because at least from the US perspective, some of those top-down requirements from a regulatory standpoint might not be coming down the pipeline in the near future. So it's really important for the industry to work closely together. Anytime ILPA puts new templates out, we do actively seek to engage with not just the LP community, who are our members, but GPs and service providers. If we spend 6, 12, 18 months working on a template and nobody adopts it, that's not beneficial for anybody. So we want to make sure we're taking into the perspective the full industry, tapping into the experience, expertise, and knowledge of the full industry, and actively work together to drive this industry forward. There's more areas that we want to do this on. We mentioned the DDQ before. That's one example of standardization, and it's been 3 or 4 years since we updated that. So at some point in the next 2 years, we should probably think about updating that again. There's such thing of updating these templates too often, but there's also such things as updating these templates too infrequently. So we want to make sure that we can get on the right cadence, identify the areas of most pressing need for the industry, and work closely with stakeholders across the industry, LPs, GPs, and the service providers that play such a key role to make sure that we can move forward with new templates and drive greater standardization and adoption in the industry. One other quick aside, in my past life, oversaw the data operations at a consulting firm. So when you talk about the challenges of collecting data, I feel that deeply and I know that deeply. But when we think about, the future of this industry, I will, when I'm talking to different folks on the private equity side, explain the concept of a mutual fund data feed and the idea that you can have one system talk to another system and have the data flow through, and you can get live updates on all this various mutual fund data and all the various, single position data. That doesn't exist on the private equity side. The only way for that to exist as we think about, the future and moving forward is to have greater standardization. Through greater standardization, it would unlock so much more possibilities from a technology standpoint. Conceptually speaking, if we think about how a lot of data gets reported today, we are going from one system on the GP side or the fund administrator side, putting that into a PDF or into an Excel spreadsheet, and then sending that through to the LP, who then needs to be able to scrape that data or manually put that into their system to then carry out the analysis. The ultimate dream would be to be able to go from one system to another, to allow for stronger data, more efficient and less error prone. And to do this, we need to work across the industry and facilitate even greater standardization and connection across all the key stakeholders.
Indeed, indeed. Well said. So let's talk about regulatory environment. Good, bad, and different regulations are there, and they have a big impact on us. So what regulatory trends do you think GPs and LPs should be most mindful of in the coming years?
Yeah, so I want to answer this in two ways, and somewhat touched on this a little bit before, but it's important to think about this from, yes, a US perspective, but then we also need to be mindful of the global perspective. So on the US perspective, I did highlight the ruling from the Fifth Circuit and the idea of, the different associations that brought that suit being able to use and file suits in the Fifth Circuit on a go forward basis. So that realistically is going to impact some of the new rulemaking efforts that are underway. The new chair of SEC hasn't been fully voted in on. We've got a acting chair who's a former commissioner at the SEC. And so we anticipate, still finding out more about some of the priorities of the SEC. But realistically, we do anticipate that there's going to be a bit of a slowdown on some of the regulatory efforts. When we think about this globally, though, because this is a global investment community, that's not the case outside the US. So there's been in the news the last couple months from the US side of things, a lot of anti-ESG and anti-DEI rhetoric and policies getting implemented. If we think about the international landscape, though, data on ESG and sustainability and climate change, as well as DEI, is only increasing in popularity, is only increasing in importance amongst both the regulatory community, but then also the LP community. So it's important for GPs to understand that, yes, what the US regulatory bodies say is important, but it's also important to understand what's going on to our neighbors in the north from Canada, across the pond in the UK and in the broader EU, as well as in other jurisdictions. And then just to double down on my point before, while the regulatory environment might look a little bit different going forward than it did the last 4 years here in the US, we as the ILPA see this as a tremendous opportunity and in many ways a need to do even more on that bottoms up standards and best practices work. I highlighted the three focus points for ILPA before, across alignment of interest, governance, and transparency. And that's what we want to actively work with the community to drive forward. One of the reasons the SEC or the ruling in the First Circuit came down the way it did was because It was identified that we are a institutional industry with sophisticated participants on both sides. So if that's the case, my challenge to the participants on both sides is to come to the table to work on making this industry more transparent, to help increase the governance, and to help positively address the alignment of interest concerns that exist.
Yeah, indeed. Indeed. So LPs are the lifeblood of the GP and vice versa. So let's talk about the GP LP relationships. Critical. So what best practices should GPs follow to maintain strong long-term relationships with LPs, and particularly in the environment we're in, the uncertainty of the markets, for example?
Sure. So, we use a lot of acronyms across this industry, and one of the set that we've used the most in this call has been LP and GP. But I think it's important to dive into those of, general partner, limited partner, and that partner. And the idea of this is a partnership. Many of our member LPs have fiduciary responsibilities themselves. The GPs have fiduciary responsibilities to the fund. And so when think about what's important for the long-term relationship, it's the idea of treating it like a partnership between GPs and LPs. The analogy of it's a marriage is often thrown out there. And I think there is at times a lot of truth to that. If you are making a investment decision as an LP to invest in a GP for a particular fund, that's going to be in the past 10 years, now increasingly 12, 13, 14, 15-year relationship that you have. And then when you think about the opportunity for re-ups 1, 2, 3 years down the road with a future fundraising from that particular GP, that extends the time horizon even further. So what we always stress is the idea of treating this like a strong partnership, being able to work closely if you're a GP with your LPs, leverage the LPAC, talk to your LPs about different questions, about different scenarios that are coming up, to make sure that they feel comfortable. Not to use these too much, but I keep coming back to it because we really do feel that they're the lifeblood of the dynamic. The idea of alignment of interest, governance, and transparency, those are absolutely critical to maintaining those long-term relationship with LPs, especially when there is market uncertainty. Fundraising is taking place during the good times and the bad. So it's important to understand the different demands at place for LPs. And it's important for everybody to work actively together. I know from having conversation with LPs, one of the discussions that they least look forward to is when they need to talk to a GP about trimming a future position or even not potentially re-upping in a position. And that's just a byproduct right now going back because of the exit slowdown and some of the distribution slowdown and the corresponding liquidity concerns, and cash management concerns. So it's important for LPs to also talk to GPs about where they are and what's important to them. But just overall, much like any partnership, much like any relationship, communication is paramount to them.
Yeah, absolutely. We're living in very interesting times from market perspective and macroeconomic political perspective. Question I always ask customers is, what's your outlook for 2025? No one's got a crystal ball, right? But I'd be fascinated to hear your view on what your outlook for 2025 is in terms of a fundraising and exit perspective.
Sure. So I'm typically a big optimist. So I think hopefully that there will be an increase in deal flow as we head forward. One item I just want to highlight as we think about that is it's really important for there to be an increase in deal flow. It's been several years now where, hey, we expect it to get better by the end of this year or next year. and several years where that hasn't really played out. And this is coming off the vintage years, 2020, 2021, 2022, when they were the biggest ever across the year in terms of the amount of fundraising and capital coming in. So we recognize that there is a lot of dry powder out there and investments to be made. But this is hopefully, and I'm optimistic, and there's some signs related to, just the eagerness and I think the understanding of GPs, that an increased deal flow is important for the long-term success of this industry. There's also, some challenging signs. The amount of deal flow activity the first 2 months of 2025 was towards the lower end of the spectrum relative to past years. So expect and hope that as some more macroeconomic stability comes about, that it will see an increase in deal flow, but that is still to be seen. I know we've asked our members about this in different surveys, and they've indicated that they anticipate that 2025 will be better than 2024 and better than 2023. Again, that was the sentiment in 2024 about the preceding year and 2 years as well. So I do think that there's optimism about it, but it's time for the GP community, and trust me, all LPs recognize that the challenges in the industry right now, but the GPs are getting paid, good management fees and good incentive allocations to be able to operate really strongly during good markets and bad markets. And I think LPs are really looking for their GPs to be able to deliver in 2025, given what has been the experience the last couple years.
So 2025 is going to be better than 2024. You heard it here first. We're going to hold you, Neal. We're being recorded.
That's the hope.
So as we take this fascinating conversation towards its final, one more question from me. So what qualities or characteristics are LPs prioritizing when selecting fund managers?
Sure. So I think a lot of it does come back to some of those core tenets, and it's the idea of what is the amount of dialogue and communication, what is the levels of transparency with this GP. Obviously, ability to provide returns is absolutely paramount when LPs are doing diligence and entering the fundraising process and analysis. But otherwise, they really want to understand what is the type of dynamic that's going to exist between us and this GP organization for the next 10, 11, 12, 13 years. What is the caliber of the reporting? What is the caliber of the communication and dynamics? One of the items that LPs increasingly here more recently have had frustrations with is the use of NAV facilities, and not just the use of NAV facilities, but the idea of NAV facilities being used and LPs only finding out about it after the fact through detailed readings and review of financial statements. That doesn't equate to a good partnership. We've put out guidance and put out guidance last year on this topic related to, when things should be brought to the LPAC for approval, when things should be brought to the LPAC and the LP base for transparency, and the type of transparency on an ongoing basis. So these are the types of things that are really important to LPs. And the challenge with pinning one down is the environment is constantly changing. These concerns with NAV-based facilities didn't necessarily exist 4 or 5 years ago. They were starting to come up, but then it was much more about traditional sublines. And so there's new tools getting introduced. And so what's important at the macro level, again, are those, the dialogue, the communication, the partnership, because that's what gives LPs confidence that as these new tools get implemented in the industry, that the right amount of discussion and involvement of the LPAC and the full LP base is going to be present from the GP organization.
Well, I've thoroughly enjoyed this conversation, Neal. I think it's been really, really fascinating to get your insights from ILPA. You've got a really interesting purview across the market. So thank you very much for sharing your insights there. If you have any sort of final comments, let me know now. But I also want to thank the audience for your valuable time. We at SS&C Intralinks were very excited about how we can support both the GP and LP community. From GP perspective, we have a launching Fund Center this year. It's a single platform to support the full fund lifecycle, from marketing, onboarding to ongoing reporting, and then InView and LP experience solutions aggregate information across all fund managers. We're very, very excited about how we can support you and your goals this year. Neal, any final comments from you?
No, it's been great having the chance once again to work with SS&C on this webcast, as well as the opportunity to work with the team as part of the templates that we just released. Hopefully this has come across, but we're really passionate over here at ILPA about trying to make the industry better, not just for all LPs, but for the entire set of market participants, and do really want to work across the industry. So welcome anybody reaching out if they have any questions or have any thoughts, and really looking forward to continuing to actively work across the industry to try to make it a better place.
Absolutely. You can find Neal on LinkedIn, Neal Prunier ILPA, and Andrew S.R. Welch, sscinsurance.com. Thank you very much for your time. Have a fantastic day and see you next time on the SS&C Intralinks Fireside Chat series. Thank you.